The Arizona sun is relentless, beating down on the asphalt until the horizon blurs into a shimmering distortion. But that heat wave is nothing compared to the financial incinerator that is currently burning through the Grand Canyon State's housing market. You are looking at a landscape where the post-pandemic wealth effect is evaporating faster than a drop of water on a Phoenix sidewalk, and the data suggests a catastrophic correction is not just possible, it is mathematically inevitable in 2026. We are about to drive through 10 specific cities where the economic foundation has cracked, where inventory is piling up to levels we have not seen since the 2008 financial crisis, and where your equity is at serious risk of being wiped out. One of these cities is facing a resource crisis so severe the state government has literally made it illegal to build new subdivisions, yet they are still trying to sell you contracts. Before we expose the data that real estate agents are praying you never see, make sure you hit that subscribe button for Tax Hack Pro. We help you protect your assets and navigate the tax implications of a shifting economy, and you are going to need that knowledge for what is coming next. Let us put the car in drive and head to the high country for our first stop. Number 10 is Flagstaff. As you ascend into the mountains, the air gets thinner, but the prices remain suffocatingly dense. Flagstaff has long been pitched as the escape valve for the desert heat, a luxury enclave for second home buyers and wealthy retirees. But economically, this market is standing on a fault line. The primary issue here is a complete and total detachment between local wages and asset prices. We are witnessing a luxury bubble that is popping in slow motion as the discretionary spending power of the upper middle class dries up. You look around and see charming cabins and massive estates, but the ledger tells a different story. According to recent data from Redfin, the median home price in Flagstaff hovers near $700,000. That figure is shockingly 75% higher than what the average local household can responsibly afford based on local income data. This is a market sustained almost entirely by outside capital. Second home buyers make up nearly 40% of all transactions in this area. From a tax and financial planning perspective, this makes Flagstaff extremely volatile. When the national economy tightens and liquidity creates a crunch, vacation homes are the first assets to be liquidated. They are the first to hit the chopping block because they are liabilities, not primary shelters. We are already seeing inventory here tick up by 22% year over year. It is also alarming to see the financial metrics for investors collapsing. The price-to-rent ratio here has climbed to over 30. For those new to the term, a ratio over 20 usually means it is better to rent than buy. At 30, it makes absolutely no financial sense for investors to acquire properties for rental income. You are guaranteeing a negative cash flow situation. Reports from the Census Bureau indicate that population growth here has stagnated to less than 1% annually. There is no influx of new blood to soak up the excess supply. Furthermore, local county records show that property tax assessments have jumped by nearly 15% in the last year alone. This is the double whammy for owners. Your market value is softening, but your tax basis is skyrocketing, increasing your carrying costs every single month. The days of bidding wars are over. Data from Realtor.com shows that homes are now sitting on the market for an average of 60 days, double the time we saw just 2 years ago. Mortgage delinquencies in Coconino County have silently crept up by 10% over the last quarter. You have to ask yourself, who is going to buy these expensive homes when the locals are priced out and the smart money is fleeing? This is a classic luxury trap where the exit door is getting smaller by the day. Number 9 is Tucson. Leaving the mountains and heading south, you arrive in a sprawling desert metropolis that has long been marketed as the affordable alternative to Phoenix. However, that affordability gap is closing for all the wrong reasons, and the market fundamentals here are deteriorating rapidly. While new developments are popping up on the fringes, the core neighborhoods are struggling with infrastructure decay and rising crime rates that are acting as a drag on property values. The market here is flashing red warning signals. Inventory levels have surged by 35% compared to last year, according to local MLS data. This flood of supply is meeting weak demand. Mortgage applications in the Tucson area have dropped by 18%, signaling that the buyer pool has simply evaporated. You are facing a significant income-to-price mismatch. The median home price now sits at nearly 9 times the median local income. Historically, a ratio of 3 or 4 is considered healthy. 9 is a bubble. Data from ATTOM Data Solutions reveals that foreclosure starts in Pima County have increased by 12%. This is a leading indicator. Foreclosures do not happen overnight. They are the result of months of financial distress finally breaking the homeowner. Additionally, the investor class that bought up properties during the pandemic is now heading for the exits. Investor purchases are down by 45% year over year. The rental market is also softening with vacancy rates climbing to nearly 8%. When vacancy rises, rents drop. When rents drop, home values follow because the yield isn't there. Another shocking statistic comes from the insurance sector. Average homeowner premiums in this area have risen by 25% due to fire and heat risks. If you're looking for tax hacks and financial strategies to offset these rising costs, make sure you are subscribed to Tax Hack Pro because we are tracking these insurance trends closely. Zillow data indicates that nearly 20% of listings here have seen a price cut in the last 30 days. Sellers are losing confidence. The job market is not helping either, with local employment growth lagging the national average by 2 percentage points. It feels like Tucson is running out of steam. Number 8 is Lake Havasu City. You continue your journey west to the banks of the Colorado River, a place famous for spring breakers, snowbirds, and London Bridge. This city thrived during the pandemic as remote workers and retirees flocked here for the lifestyle. But the party is officially over. What you're seeing now is a hangover of epic proportions, driven by a collapse in the short-term rental market and a realization that the remote work boom has reversed course. The numbers here are terrifying for anyone holding real estate as an investment. According to AirDNA, revenue for short-term rentals in this market has plummeted by 30% over the last year. This has caused a massive sell-off among amateur landlords who bought properties using debt service coverage ratio loans. When the income stops, the loan gets called or the property gets dumped. This has led to a 40% increase in active listings on the sales market, flooding the area with furnished homes that nobody wants to buy. You are also looking at a demographic ticking time bomb. The median age here is over 54. As the boomer generation downsizes or passes on, there is simply not enough millennial or Gen Z demand to replace them. Data from Redfin shows that the sale-to-list price ratio has dropped below 97%. This means sellers are accepting significantly less than their asking price just to get out of the holding costs. The average days on market has blown out to 75 days. Liquidity has dried up. Furthermore, water levels and conservation restrictions are becoming a major concern, with uncertain future access dampening long-term property values. Local economic reports show that the hospitality sector, a major employer here, has seen a hiring freeze. Mortgage data reveals that second home mortgage rate locks in the zip code are down by 60% from their peak. Even more concerning is that new construction permits have stalled, dropping by 25%. Builders know there is no demand. This was a boom town built on easy money and speculation, and now the foundation is crumbling. Number 7 is Goodyear. Driving back towards the central part of the state, you enter the West Valley, an area that has seen explosive and often unchecked growth. As you cruise down the wide avenues, you pass row after row of stucco houses that look exactly the same. 2 years ago, these were snapped up instantly. Now, signs are fading in the sun. This city is a prime example of urban sprawl finally hitting a wall. The issue here is a simple case of massive oversupply coinciding with a sharp pullback in the industrial warehousing boom that drove employment in the region. The statistics for Goodyear are staggering. According to the Cromford report, the supply of homes for sale here is currently 50% higher than the historical average for this time of year. That is a massive overhang. You are seeing builder incentives reaching desperate levels. Some developers are offering up to $30,000 in rate buydowns and closing costs just to move units. They are effectively paying you to take the house because they cannot lower the list price without angering the previous buyers and lowering the tax comps for the entire subdivision. Despite these incentives, new home sales have slumped by 15% year over year. Resale values are taking a hit too, with the median price per square foot dropping by 7% over the last 12 months. It is also worth noting that this area has a uniquely high concentration of Federal Housing Administration (FHA) loans. Recent data shows that delinquency rates for these government-backed loans here have ticked up to nearly 5%. Commute times are another major factor killing demand. With gas prices remaining volatile, the 45-minute drive to the Phoenix city center is becoming a financial deal-breaker. Commercial real estate vacancy rates in the area have risen to 12%, suggesting the local economy is slowing. Zillow data highlights that 30% of the active inventory has been on the market for more than 90 days. Institutional investors who own large portfolios of single-family rentals here have stopped buying completely. Goodyear built too much, too fast, and the correction is here. Number 6 is Bullhead City. You head north along the winding river to another border town facing an existential crisis. This location is heavily dependent on tourism and spillover traffic from the Nevada casino industry, both of which are showing clear signs of weakness. But the bigger story here is the environmental reality hitting residents in their wallets. As you drive through the streets, you can feel the oppressive heat. Insurance companies feel it too. This is leading to an affordability crunch driven by premiums. The market statistics here suggest a deep correction is underway. According to local real estate board data, the number of closed sales has dropped by 22% compared to the same time last year. You are looking at a market where the median home price is still inflated by 40% over 2019 levels. That is a massive gap that needs to close. Insurance premiums in this high heat zone have skyrocketed by 35% in just 1 year. This acts like a hidden tax. It increases your debt-to-income ratio and disqualifies marginal buyers. Vacancy rates for rentals have climbed to 10%, the highest in the region. Data from the Bureau of Labor Statistics shows that the local unemployment rate has crept up to 5.5%, noticeably higher than the state average. This lack of economic stability is causing default rates to rise, with early-stage delinquencies up by 14%. Furthermore, inventory of riverfront property has doubled in the last 18 months. Reports indicate that inbound migration to this area has effectively hit zero. With a limited local economy and rising costs of living, the value proposition is vanishing. Number 5 is Casa Grande. Traveling south down the interstate, you reach a city that sits geographically halfway between Phoenix and Tucson. For years, this was pitched as the ultimate commuter hub and a future industrial powerhouse. While some industry has arrived, the housing market got way ahead of itself, driven by speculation rather than end-user demand. You see vast tracts of land cleared for subdivisions that have paused construction. The data is concerning. Active listing inventory has exploded by 60% year over year. According to Redfin, nearly 40% of sellers have had to drop their price to attract an offer. The promise of high-paying tech jobs from electric vehicle manufacturing has not materialized fast enough to support the housing hype. You are also seeing a surge in shadow inventory, homes that are vacant but not yet listed on the MLS, estimated at nearly 10% of the housing stock. The absorption rate has slowed to 5 months, bordering on a confirmed buyer's market. Rental rates have softened significantly, dropping by 6%. This hurts the calculation for investors banking on cash flow. Local records show that permits for new single-family homes have plummeted by 30%. Builders see the writing on the wall. The average credit score of buyers in this area has dipped, indicating that only those with marginal financing options are still trying to buy here. Number 4 is Maricopa. You navigate through the open desert to a city infamous for its isolation and notorious traffic bottlenecks. This bedroom community offers large, modern homes for lower prices than the city center, but the lifestyle cost is catching up with the market. The commute is a nightmare that steals hours from your day and dollars from your wallet. With remote work policies reversing, the demand for living this far out is collapsing. The numbers illustrate a rush for the exits. According to the Cromford report, the annual supply of homes for sale has increased by 45%. Homes are lingering on the market for an average of 80 days. The foreclosure rate here is one of the highest in the state, with pre-foreclosure filings up by 20%. Data from Zillow shows home values have already dipped by 3%, but the acceleration of price cuts suggests the bottom is still far away. The ratio of sold price to list price has fallen to 96%. Additionally, property taxes have increased significantly due to new school bonds passed to support previous growth. This adds more strain to family budgets. Investor activity has dropped off a cliff, with institutional purchases down 50% year over year. The local vacancy rate is high, hovering around 9%. You also have to consider that this area is prone to flooding, and flood insurance costs are rising. It is a trap for equity that you might never get back. Number 3 is Santan Valley. You continue your loop to the Southeast Valley, an area that exploded with growth but forgot to build the infrastructure to support it. This unincorporated community is a sprawling maze of subdivisions with very limited commercial zoning. Without a strong local tax base from businesses, the tax burden falls entirely on homeowners. The statistics here point to a deep freeze. New listing data indicates a 55% increase in homes hitting the market compared to last year. Homeowners are rushing to cash out. At the same time, closed sales are down by 20%. You are dealing with a severe water infrastructure problem. Private utilities here have raised rates by nearly 40%, shocking homeowners with bills that rival car payments. According to Redfin, the share of homes sold below asking price is now over 70%. The median days on market has tripled. Builder confidence has collapsed, with new housing starts down by 35%. Pinal County records show a spike in tax liens, suggesting homeowners are struggling to keep up. The rental market is oversaturated, with listings up by 40%. This is essentially a giant dormitory losing its residents. Number 2 is Queen Creek. Just north of the previous stop, you enter a town that marketed itself as an upscale agrarian paradise. Prices here skyrocketed, doubling in a short period, but gravity is kicking in. What went up vertically is coming down. The valuation metrics here are off the charts. The median home price surged to over $600,000, but current appraisals are coming in low, killing deals. Data shows that cancellation rates for new construction contracts have hit nearly 20%. Buyers are walking away from deposits rather than closing on negative equity. Inventory of homes priced over nearly $1 million has doubled. There are simply no buyers at that price point in this interest rate environment. According to Realtor.com, the number of listings with price reductions is currently at 35%. The average mortgage payment for a new purchase here has increased by 60% in 3 years, alienating the move-up buyer. Local data shows the days on market for luxury homes exceeds 100 days. These estates are turning into stagnant assets. Fix and flip investors have retreated as margins are wiped out. Permit data for pools and additions has dropped by 40%. This town flew too close to the sun. Number 1 is Buckeye. You have arrived at the final and most critical stop. Located on the far western edge of the metro area, this city was the poster child for unchecked growth. Now it faces a reality check that could render thousands of planned homes unbuildable. The issue here is elemental: water. The state has released a report stating that the groundwater basin here cannot support the planned growth, leading to a halt on new subdivision approvals that rely on groundwater. This is a regulatory bombshell. Current data shows that inventory has spiked by 65% as investors try to exit. According to Zillow, home values are already down 5% year over year, the steepest decline on our list. The vacancy rate for rentals is over 10%. Foreclosure filings have jumped by 25%. Builders are slashing prices by up to 15% and offering massive incentives to dump inventory. You are looking at a location where the primary asset, the ability to grow, has been legally challenged. Without a guaranteed water certificate, land values plummet. Redfin data shows the buyer demand index for this zip code is at a 5-year low. This is a trap for the uninformed, and the risk of capital destruction here is higher than anywhere else. The road through these cities reveals a pattern of overextension, resource scarcity, and economic fragility. If you found this analysis helpful and want to stay ahead of the coming changes in tax laws and property values, make sure you subscribe to Tax Hack Pro. We break down the numbers so you don't become a statistic. Leave a comment below telling me which city you think will crash the hardest, and I will see you in the next video.